What does the early signs or what early signs do you see of virtual meetings resulting in real cash?
I think they will. So, the guidance that we got. So we talked to a set of prestigious VC funds, in preparation for our demo day, and the guidance that we got was that most of them are doing, all of them right now, obviously doing virtual meetings. They like to do socially distanced meetings before they write their check, but we've seen people write checks without ever actually having met. There's a strong, to date, it's been if you've had a previous relationship with that fund or if they know you, that's a huge bonus. But I actually think that it's going to become a lot more meritocratic. The ultimate issue is that all these funds, especially if you look at the dry powder funds, there's been a lot of dry powder that was raised in the last 2 years that's not committed. They need to deploy capital unless they have to worry about their IRRs. So they still need to write checks. And the reality is that it's too cumbersome to try to meet with founders. So you need to set these meetings up and you need to drive things virtually.
So if they're not getting the read on the founder, they're not getting the charisma of the founder and that sort of situation in person, what do you think they're making their decisions on? So they've removed that high touch, the feeling in the room they get. What are they looking at to replace that in their decision-making stack, these downstream investors?
Well, I do think that all investors have different shticks and they're not a monolithic group. So there are some investors that pride themselves on betting on people and teams. And I think those investors will probably invest closer to people that they know or that they're connected to, that they can validate them in some way. And so I think there are, you need to try to find a proxy to get that investor to trust you. I think other investors actually are just being much more meritocratic about doing customer diligence like they should, looking at the product, looking at the data, and making decisions based on that. I do think valuations are going down by 20% to a third.
Which puts us at double reality probably in all cases, here in the Valley. So an example of that might be a $15 million valuation last year goes down to what, 12 or 10?
Yeah, I would say 10. So it depends on again, every company is different.
Sure, there's outliers.
But my main point here is that I don't think investors are not investing. I think they're correcting for that risk by adjusting valuations.
Yeah.
And I do think that if you're in a market which is where you're getting wins in your sales because of COVID, so collaboration, cloud, e-commerce, digital health, then I think there are investors that are moving even more quickly. So,
how do you deal with competitive companies coming to the accelerator? You have some breakout success doing quantum computing. Another person comes in and says, I want to build a company that defeats that company. We have a better model. Do you not invest, or do you invest and the founders of that company understand that you're an accelerator and you're going to invest across a wide range of companies?
Our rule is that we will not invest in a competitor within the class that we admit or within one class after or before that company that we admit. So we keep a one class buffer so that because the biggest thing that we're building is a trusted space, both physically and virtually, and so we don't want to compromise that. And the reality is that companies pivot all the time. So even if we admit somebody that doesn't look like they're competitive, they may end up pivoting into that space. And it's been a big boon for most of our alums. So, Rigetti is I think a fairly famous quantum computing company that's graduated from Alchemist. We also have had now this ecosystem of other quantum computings like QCware and others that will benefit Rigetti. So, and LaunchDarkly, I think, is going to also have a bunch of great DevOps companies that will come from Alchemist that will benefit LaunchDarkly.
Yeah, this is something that outsiders don't understand. As the Sequoia folks said, no conflict, no interest. Like, usually these things seem a little conflicted, but even that's okay because the big company might wind up acquiring the small one. So if I invest in a company that is working on sleep, but I'm also an investor in Calm, I bet you Calm feels pretty good about that. At least they know that if they were going to acquire that company, they would have somebody who could do a proper introduction, right?
Yeah, no, that's exactly right. And it's amazing how, in my experience, I understand that founders have this fear of competition. In general, I think it's better to jump into situations where there's a lot of people within your ecosystem that could be relevant. At DFJ, we 3 times funded, I know we keep going back to DFJ, but there are 3 times we funded competitors, not intentionally, they became competitors, but all 3 times, both of the companies did well. So
Yeah.
in any space, there's going to be usually three winners. If there's a market that is ripe for a venture opportunity, there'll be one winner that'll be the outlier that nobody can acquire, that'll go public. And then the other two will get acquired by the incumbents in the space that need to have a strategy there. So in general, I would not worry. I know it's easy for me to say this, and there are exceptions, but founders, don't worry too much about competition. Worry about learning and the pace of your development.